All right, welcome to The Explainer. We're jumping right into it today because we are looking at a massive, honestly kind of crazy contradiction happening in the financial world right now. If you've glanced at the financial news this week, you've probably noticed a total clash between two completely opposite narratives. It's a true market paradox. So we're going to unpack exactly what's going on using the raw data to see what's actually happening beneath the surface.
Look at these two headlines. On one side, we've got headline 1 telling us, history says investors who stay the course always win. You know, hold on tight, don't panic, you're going to be totally fine. But then, right next to it, headline 2 is just sounding this massive alarm, citing Warren Buffett and warning that stocks are facing their sternest challenge in 155 years. I mean, this is the exact same market, but we're getting two completely different messages. So how on earth can holding always win when we're simultaneously facing a century-and-a-half level threat? Like, which one is actually true? Well, let's find out.
Section 1. The case for staying. The historical data behind the bull market.
Okay, let's dive into that first headline, the one arguing that holding long-term works. Factually, this statement is absolutely correct, and the numbers here prove it. Since 1950, the S&P 500 has experienced 38 separate declines of 10% or more. Think about that for a second. That means a 10% drop happens roughly every 2 years. It's just a completely natural, baked-in feature of the market. And out of those 38 declines, 12 turned into official bear markets, which are drops of 20% or more. So, the reality is, the market drops frequently, and sometimes, it drops hard.
But here's the actual math on those painful bear markets. When you're in one, it feels like it's going to last until the end of time, right? But the average duration of a bear market is just 289 days. That's only about 9.5 months of actual decline. And the average recovery time to get back to where you started? About 14 months. So when you zoom out and look at an entire lifetime of investing, these terrifying drops are actually pretty short-lived events.
And this brings us to the ultimate point for the bulls. 100%. Literally 100%. If you look at any 20-year rolling period since 1926, the S&P 500 has never lost money. 100% positive returns. So the historical proof is just undeniable here. If you've got a 20-year time horizon, selling in a panic is statistically the absolute worst thing you can possibly do. Staying the course just wins.
Section 2. The 155-year challenge, valuation extremes, and the bear case.
So what about that terrifying second headline, the 155-year challenge one? Well, it's not just media hype, it's raw math. And it all stems from the CAPE ratio. CAPE stands for Cyclically Adjusted Price to Earnings. It was developed by Nobel laureate Robert Shiller. Basically, instead of looking at just one single year of corporate earnings, which, can be super noisy, this metric averages 10 years of inflation-adjusted earnings. It smooths out the business cycles. Think of it as the ultimate noise-free thermometer for how expensive the stock market actually is at any given time.
If we look all the way back to 1871, literally before the telephone was even invented, the historical average CAPE ratio is 17. That's our baseline normal. But look at today's CAPE. As of August 2026, it sits at an astonishing 41.9. We are at more than double the historical norm. When journalists are saying this is the sternest challenge in 155 years, this is exactly what they're looking at. The market is just incredibly, historically expensive right now.
To put this into an even more sobering perspective, today's valuation of 41.9 has only been exceeded one single time in recorded history. Just once, December 1999, the absolute peak of the dot-com bubble, when the CAPE hit 44.19. We are hovering right at the exact same heights we saw immediately before the NASDAQ crashed by 49%. That is the gravity of the bear case we're dealing with today.
Section 3. The Warren Buffett warning. Following the smart money.
Let's ground these abstract math concepts in the real world by looking at one of the greatest investors of all time. In a 2026 CNBC interview, Warren Buffett stated point-blank that the market has a casino atmosphere driven by option speculation. He literally used the word gambling. Now, Buffett doesn't just throw words around lightly. He is genuinely deeply concerned about the highly speculative behavior that's currently driving market prices.
And Buffett doesn't just talk, right? He acts. Look at this jaw-dropping number, $397.4 billion. Just let that sink in for a second. That's the amount of cash and short-term treasury bills Berkshire Hathaway is currently holding. It marks the single largest corporate cash pile in United States history. He is pulling money off the table at an absolutely unprecedented scale.
And he hasn't just paused his buying. Berkshire Hathaway has been a net seller of equities for 14 consecutive quarters. That is 3.5 straight years of selling stocks, not buying them. So while the market has been soaring higher and higher, the most famous long-term holder in the world has been quietly and systematically cashing out.
And here is exactly why he's doing it. This number, 237%, represents the current level of the famous Buffett Indicator. That's the total stock market capitalization compared to the entire U.S. GDP. Back in 2001, Buffett famously warned that when this ratio hits 200%, investors are playing with fire. Today, we aren't just at the fire line, we are 37 points above it. The smartest money in the room is looking at this exact metric and taking a massive step back.
Section 4. Reconciling the market paradox. How both headlines are true.
Okay, so here's what finally solves the mystery for us. The first headline says you win if you hold long term. The second headline says we're in historic danger. Well, they are both right. Look at the forward return projections based on the CAPE ratio. Historically, when the CAPE is cheap, like below 10, you get about a 10% annual return for the next decade. When it's expensive, say above 30, that return drops to roughly 2%. Today, sitting at a CAPE of 41.9, historical models project an annual return between 0 and 2% over the next decade. So the absolute crucial point here is this. Winning in the long term right now simply means you won't lose money over a 20-year timeline, but you might entirely flatline for the next 10 years.
Section 5. What you should do. Actionable steps for today's market.
Now, I don't want to just leave you with scary macro data. I want to empower you. Here are 3 actionable takeaways to protect your investments right now, without gambling or trying to time the exact top or bottom of the market. Number 1, know your time horizon. Number 2, use dollar cost averaging. And number 3, treat cash as optionality. Let's break these down quickly.
First up, your time horizon literally dictates everything right now. If you're retiring in the next 3 to 5 years, you absolutely need to be defensive. High valuations might not guarantee a crash tomorrow, but they practically guarantee low returns for a while. However, if you have 20+ years until retirement, then market volatility isn't a threat at all. It's a massive buying opportunity. You actually want the market to drop so you can buy in cheaper over the next 2 decades. Second, we have dollar cost averaging. This is just the ultimate antidote to market anxiety. Instead of dumping all your money in at once and being terrified it might crash the very next day, you systematically invest a fixed amount every single month. By doing this, you're using pure math to smooth out your risk over time. If the market drops, your fixed amount automatically buys more shares at a discount. You just remove the guesswork entirely.
Third, remember that cash is optionality. We just saw Warren Buffett holding almost $400 billion in cash. Right now, with yields on safe treasuries sitting above 5%, holding cash isn't trash like it was a few years ago. Getting paid 5% to wait safely, that's a highly valid strategic position. It represents patience, not panic. It gives you the dry powder you need to strike when valuations finally come back down to earth.
So you really have to ask yourself, are my expectations actually realistic right now? Because ultimately, expecting massive 10% returns starting from today's sky-high valuations is probably just going to lead to severe disappointment. But if you reset your mind and expect 0 to 3% returns over the near term, you're totally prepared for reality. And hey, if the market happens to do better than that, it's just a fantastic bonus, right?
Let's wrap up with this grounding mantra. Stay disciplined, stay diversified, stay patient. The paradox is totally solved. History promises that long-term investing works, but current valuations promise the immediate road ahead is going to be rocky. The ultimate victory goes to the disciplined, not the guessers. So, as you look at your own portfolio today, are you positioned to survive the storm, or are you just gambling at the casino? Thanks so much for joining me in this explainer, and I'll see you in the next one.